Welcome, everyone. I'm Greg Schnell, the host of the Market Buzz. This show discusses weekly setups across the market. Using the tools available on StockCharts, we'll look for longer time frame trades. And we got lots to talk about. Happy New Year. Thanks for taking the time to join me. Big year in the markets last year. We're going to cover off a little bit of that. I'm going to talk about a couple of other things as well. Let's get into the agenda right away here. One thing that I'd like to make everybody available is we have the Market Vision on Saturday, tomorrow, January 4th, and it's all the StockCharts technical analysts, so I hope you'll be able to join us there. January 4th, register at earningsbeats.com/marketvision, and if you just follow this address there, it'll take you right in there, and then you can investigate it, but it should be pretty good. I think it's going to be quite impressive. John Murphy's going to speak. It's very rare that you get John Murphy to do a presentation live. Most of his stuff is written text. So if you want to catch that, that would be great. And I'm also going to be involved in the Wealth365.com Summit on January 20th to 25th. So if you'd like to join us at that, that would be great as well. Okay, for our agenda, a little review of what worked well in, that should say 2019, and I guess over here I should say 2020. My mistake, old habits die hard. Looking for new opportunities, and is it time to hold your firepower? So let's check the charts. One of the things that I think is most important is just giving a quick review of what worked well, and maybe you've already seen enough of this, but this is over a 1 year period, and just taking some simple stuff like here's the semiconductors ETF, and it was up 62%. Obviously, that's a massive rally off the December lows of 2018. So really big. And the technology sector followed along. Apple was just a monster. Microsoft was a monster. So both of those contributed in a big way to the outperformance of the overall technology sector. Banks did really well. Big names like JP Morgan were up nicely. In the communications group, they fared not quite half of what technology did, but you can see there's dramatic difference in performance there. So that was kind of surprising. Right in line with industrials, and remember, industrials had the weight of Dow hanging in there, FedEx hanging in there. So there was a few big names slowing down the industrials, and yet they were still able to keep up with the communications. Discretionary was only off slightly, so that's another good showing there. And Amazon just started to move towards the end of the year. We'll see if it's got any firepower left here as we head into the spring of 2020. Real estate was really strong for most of the year, and then once the rally started in October, real estate kind of backed off. So while this was an inline performance, it actually was up much more and then pulled back. Staples and utilities, the REITs, staples and utilities all had a pretty good year, actually. When you consider that the market was rising all year, they did okay. I think the one thing that's more important is that rotation out in October. Everybody moved into the growth sectors, and these guys got hit a little bit. I would say utilities is still up where it was, but it didn't really grow while everything else shot up. Materials, they had it tough with the trade war or the trade discussions going on all year. It was pretty hard to get a bid on copper and steel and that kind of thing. Those charts all wandered sideways for a while. Nothing really there. Healthcare took off in latter part of the year with the biotech sector really breaking out and some nice stuff in some of the healthcare providers. But I think the biggest thing to watch for here as we roll through 2020 is, do we continue this technology outperformance? The last two sectors, let's just briefly cover those. Retail is obviously a part of consumer discretionary up here, but the big thing I want to show is how weak it was. It was less than half of discretionary, and autos didn't do well either. So, you see all of this retail really struggling to find their way. And I just think in general, Lululemon and a few names like that, Costco, Walmart, Target have done okay. But the rest of them it's been hard for them. And energy was a really big underperformer. It shot up a little bit at the end of the year to get this little gift. But I think for most of the year, it was flat to down. And here's E&P. really struggling. So the exploration and production ETF started in 13 years ago, so something like 2007. And the problem is that ETF is below the level it was at, and the oil services index is below where it was 20 years ago. So I actually expect some outperformance from those group in 2020. The Canadian sectors, the technology sector, this one's filled with some small companies. One called Shopify that you might know was up 300%, so that obviously helped pull this pretty high. And then gold miners, they did well. They had a great year, up 40%, so besting the S&P 500 for the year, so that was pretty good. Utilities in line with the U.S. utilities. Industrials, okay, nothing really great. Income trusts held up really nicely. Materials, again, this would be the other miners and minerals and that kind of stuff, didn't do that great, but 20%. TSX is on hold, so that the Canadian index was up 19%. And then we see the real estate group lagging a little bit, but the financials in Canada had a weak December, so they actually finished quite mellow when you compare that to the US performance, I think, which was 30% or 33%. And then the discretionary for Canada, again, very weak. We don't have the big sectors like the autos and that kind of stuff, so really an underperformance there, not very strong at all. And then getting out into the telcos, all three of the Canadian telcos, Bell, Rogers, and TELUS, really didn't have a great year. There's a few other companies around that space, but for the most part, it was pretty sad. And then energy was very iffy. And I'll show you one chart coming up here on the next slide, I think. Actually, 2 slides out. But energy was 5% in Canada, and most of that's oil and gas. So but I want to compare that with what Canadian crude did. So I'll show you that in 2 charts here. And then healthcare, this one was dominated by the marijuana names. And so while we had some good stocks moving up in healthcare, some nice biotechs and stuff, we also had the marijuana names fall under the bus. So that area didn't do very well at all. Looking around the world, Russia was able to outperform in a big way, up almost 50% better than the S&P 500, which is just crazy to think about after the great year Canada had, or America had. But that Russia number was wow, really strong. And then we see the NASDAQ second, Brazil third. So 2 big commodity countries did really well. And then if you look just halfway down, you'll see Australia and Canada, the other 2 major commodity countries, didn't, they were just 20% or so. So they weren't a long way behind, but they were more in line with the Dow than with the S&P 500. Some quick hits there for Europe, France, and Germany, both around 25%, so in line with the U.S. market. The Shanghai actually closed right near kind of the 1-year highs, just settling in there, trying to break out. We'll see. I know it did break out this week. We'll find out if it can hold that or what's going to go on there. So that one's interesting to watch with the new Phase 1 trade deal. And then Japan, obviously quite weak at 18%. Just lots of trade conflict there, some South Korea issues, China issues, U.S. issues. So they were hurting a little bit, and of course they've got other fiscal issues going on. India was a big surprise. The best demographics in the world to only do 14% was really shocking for me. And then London with Brexit and everything else going on, it's amazing that Brexit could possibly, all of the weight of Brexit and all of the back and forth, and yet they still eked out 13%. And I don't want to say it's in line with Canada, Australia, Japan, but literally, all in the teens there, so nothing fantastic. Hong Kong ended the year with the protests going on, so that's been kind of holding things back there. South Korea, big trading partner over in Asia. The problem there, obviously, is just more trade deals to be worked out. And when China got slow, so did South Korea. Mexico and Indonesia, pretty weak markets all in all. So I would just say, looking around the world, I think it was a surprise that Russia and Brazil were the 2 best, I'll call it, all-country indexes. The S&P 500 to actually come in under those 2 was quite a surprise. But then the other 2 commodity-based countries, Canada and Australia here, didn't really do that well. So comparatively, considering Canada sells all their stuff to the US, or 80% of it, you'd think we'd have done more in line with the S&P 500. Okay, look at this Canadian crude number, up 100%, and yet the Canadian energy names, let's just go back 2 slides, were only up, yes, 5%. So that's just crazy to have crude up 100%. And there was a real mismatch in crude there at the end of 2018, but still you would have thought that this number would have rallied somewhat more on the back of a crude improvement of around 100%. So that was quite stunning. Nickel, and let's just kind of highlight nickel here. That was a really good industrial metal. And then if we go down and just scan for a few here, we've got steel down in here. And I was surprised that steel outperformed copper. And these are the ETFs. This was the ETF for the steel companies. So it did better than copper. I don't have the actual cold roll steel, just tracking this SLX. But looking across the industrial metals, they were very big underperformers, and that's what we saw on the U.S. sector listing. Gold and silver, again, great years, and it looks like they're on their way to start another one here. I think as I'm going through this, gold is sitting up around 15 and a quarter, so that's pretty good. West Texas crude obviously had a big year, up 35%, sitting over $61. I look at that chart and it's gone sideways for a couple of days, and I'm seeing stuff on my Twitter feed that oil's topped. It just seems really early to call it to me, but crude did have a quiet day on Thursday, and we'll see how it responds on Friday with a little bit of fireworks on Thursday evening over in Iran. So that's a big question, but I like to see gasoline and heating oil kind of support the move in crude oil, and we're seeing that. So that looks good to me. Looking at lumber, this has been a great mover, up 25% on the year. And the interesting part is the lumber stocks are still beaten down quite bad. I think there might be a big opportunity there in the lumber area looking into 2020. Brent crude, performed pretty much, almost 50% less in terms of gain than West Texas crude. So it wasn't nearly as boisterous there for Brent. But I think, going forward, I still think there's going to be some supply disruption from Saudi Arabia. We've still got some issues with Venezuela. There's a few other things going on that I think support the price of crude. So I'm looking for that area to perform better. The actual price of gold was only up 18% and silver 15%. And as you can see, the miners were the big way to play that. And I still think that goes on right now. If gold is going to start to percolate, I think you want to be in the miners. They move quite a bit faster. And then I already mentioned the industrial metals, but the lithium ETF and the rare earth metals ETF really were terrible last year. The lithium ETF, I think, even has Tesla in it, which performed pretty well. So that tells you how bad everything else was. But looking at that, if we're going to get a big move in materials, these two could be a great area for big gains into 2020 or 2020. Natural gas, obviously ugly down here at 25% loss for the year, only $2. It's barely economic to produce it, and that's why there's so much flaring of it in the U.S. And then when we see marijuana stocks, the ETF topped out roughly around October 17th, which was Weed Wednesday, the main day in Canada. That marijuana was legalized countrywide, and they've been tapering ever since. There's been a few little bounces here at the end of the year, but not an area I want to get too pumped up about. And lastly, I want to say thank you for following my work in 2019, and hopefully we'll have more good information for you coming up throughout the year. Okay, this is as of January the 2nd, so Thursday evening at 5:15, and we are at 97%. And when I look on my Twitter feed, everybody's like, it's a bull market, it's a bull market, it's a bull market. And I can't help but at least be aware of how extreme we are. And again, last year I think it was down at 2 on December 26th or something, so it was quite low. There was no real upside pressure, and everybody was afraid. And obviously you want to be buying here and selling over here, not buying over here and selling over here. So the big thing for me at this point is I want to take a step back and actually pause a little bit. I got a couple of things that make me wonder what's going on. And so as an example, what could possibly rock this? Well, why did the Fed take 9 months to sell off $400 billion worth of assets and only 3 months to buy them all back or flood the market with them? So, so when you see this kind of change, this massive level of change, liquidity being inserted by the Fed, 400 billion isn't something you do at popcorn at a movie. So I'm thinking it's a little bit bigger. There's something going on. Jay Powell met with Trump, President Trump, a few weeks ago, maybe even a month ago already. So, it's not like everything is fine. We had the emergency meeting in October that has been pretty much downplayed. But in the background, there's something big going on when 400 billion has to get inserted into this. And this is right from the Federal Reserve Bank of St. Louis. On my Twitter feed, somebody said 200 billion. Over here, it's, a different number. But the bottom line is from this low point on here to the high point here, I think is 410 billion. So this is quite a ramp considering in September we were, 3.761 trillion, and now we're there's the number 4173. So anyway, with that huge upswing, I cannot help but wonder what's going on in the back. That the Fed has dropped rates or stalled with our rates here, and as we go forward looking at the numbers, why is the Fed working so hard to stabilize this market? And the market keeps screaming higher, and yet earnings have been relatively flat. So it's a real conundrum to figure it all out. And again, I'm a technician, so I don't really try to match economics with the stock market. If the price action is higher, that's where we want to be. I've been bullish all the way from October up here, just saying buy the market, buy the market, buy the market. And I continue to be that way as long as the market's holding up here. The one fly in the ointment here is the bond market is trying to tell me something, and I haven't got it all figured out, but I got to tell you, it's something I'm watching every week now to see what's going on. So that's one of the places, when you consider the market just flying to an all-time high, and the rest of the world is doing a pretty good job of following. I will say I've never seen a market top without an uptrend in front of it. And so, it's okay to have an uptrend. What we need to be aware of is the potential for a market top when we see, screaming fear and greed indexes up around here. And we've got, we still have to get through China phase 2. We've got the election coming up in the U.S. this year. We've got relatively flat growth in Europe. We've got a couple of unstable countries out there, and the oil market is starting to heat up with a little bit of the Saudi issues going on, and a few more tensions in the Gulf and the Strait of Hormuz. There's lots to worry about, and obviously when the market pushes those aside, that's great. I'm just saying if they ever start to show up all of a sudden, well, boy, it'll be obvious, but right now the market is trying to drive higher. One of the places I am quite interested in right now is the gold trade, and one of the reasons for this is we have this uptrend in gold where gold is outperforming the S&P 500 over a 1-year period. And the big thing for me is as long as it's an uptrend, I want to be involved, and when it's a downtrend, I don't want to be near it. So we have this really interesting inflection point coming up right here. So we have a downtrend and gold starting to outperform and turning up. And we have the possibility of this actually just starting to fall down and break my uptrend. Well, if gold is going to start underperforming, I don't really want to be involved in gold. So I would say we're at one of those decision points, and I've Sometimes you can call them precious metals, and sometimes you can call them the precarious metals. To me, there's a few things I like on this chart. I like the full stochastic getting back above 80. This could go up here and run for a couple of months, or 3 or 4 months. This could be very bullish. So I really like this getting back above 50. When it stalls at the 50 level on the way up, that's a bit of a problem for me, so I don't like that. The volume has been really declining all the way through this consolidation period, and we had really, really low volume in the last, I'll call it month, last 2 weeks anyway. So the volume here has been quite light, and we're around the holiday season, so that's to be expected. We can see that down in here and down over in here. But the last 5 years have all seen ramps up in December going into January for gold, so its seasonality is quite good. I'm not a big seasonality trader, but I do like the setup right here where things are starting to break out. So this gold is pushing up, and again, I think we're at 15 and a quarter, and pre-market has it up at 1540. So gold is moving up quite nicely. I have a couple of things that don't look good to me. Like, one of the things I like is when my momentum indicator stays above my trend line. So that's not great that this is pulled back below, but literally it just pulled below and then started to flatten out. If this is going to turn up above zero, that's very bullish. That's things we see in a big major uptrend. And so I would really like to see this kind of come down, cross up here, and start to accelerate higher again. And when you get that sort of thing, that can be a very bullish picture. Let me just go get some examples of that. So here would be JP Morgan, and we're just going to go to a weekly chart. And what you see here is it comes down, it touches, it makes another wave, comes here, starts to make a wave higher, another wave higher, another wave higher. So these bounces above zero can be very, very powerful and really part of a big, big, big uptrend. And we saw the same thing over here where it was below zero, started to make higher lows, bounced above zero, rallied a little bit, then pulled back. But as long as this trend is continuing up, I think that's very, very bullish. And so what we see here on JP Morgan, obviously it's been trending nice and high for a while. We're getting up around the 5-year high, so that's a little bit of enthusiasm. This is another kind of example of why things might pause. And excuse me, and so when we see these charts with this big thrust, I think one of the things that we need to be aware of when these thrusts happen is this is the kind of thing that could potentially slow the market down. Yet over here on gold, we're just starting to turn up. If the market was, I was going to say, climb a wall of worry, October, November, December 2018, when the stock market was going down, gold was going up. So perhaps if this is going to continue to climb up into January and February, and JP Morgan takes a pause or whatever, something like that, then all of this starts to fit together. So those are just some big perspectives. The other one I have is the US dollar, and I'm sure you've all heard, but I've been talking about it for about a month, and now all of a sudden it's starting to get on the radar as it makes 6-month lows. So we're getting a bit of a bounce this week where we've dropped down to 6-month lows, and now we're bouncing back up, and we'll see if we get any sort of horsepower here. But we have a PPO momentum below zero. That's not usually a good place. Now it can come down here and bounce and start to turn higher. It can do that any week. The big thing for me is normally when things like the last time it went below zero, this was just getting started, and look at the ride down the dollar took all through 2017. So that's one of the big pictures for me, is that the dollar is starting to change its complexion, where the PPO momentum, I'll call it, has been rising. It's been above zero for 18 months, but it's also been rising since September of 2017 in a big picture way. It's either been rising below zero or above zero and slightly declining, but still positive momentum, so above zero. We haven't been below zero since 2017. Now, that can help global growth, where all of a sudden, if the dollar gets weak, the people start to invest in the rest of the world, and as the U.S. Treasury market changes somewhat, that can change the money flow, so U.S. dollars aren't so in demand, that kind of thing. My bigger picture is that we have one big setup on the US dollar, and I've mentioned it a couple of times already, but let's just unwind the tape here to 40 years. And the perspective I want to make is this big uptrend here in the dollar comes in around 94, 95 cents. We'll just go to a monthly line chart here, or even quarterly would cover it off. And what we want to show here is that when these big trends change on the US dollar, they're important to be aware of. And so in this particular case, we had a big trend change here. Then we had a 10-year basing project where it went like this. Then we had a big uptrend. Then we had another downtrend, a 10-year basing project. And then we've had a big uptrend. And now that uptrend is starting to look, I don't want to say threatened, but under consideration. So when we see this, and this is a monthly chart, but you just see the dollar rolling over here in a big way, dollar rolling over. Now we've got lower momentum, but nonetheless, the dollar is rolling over, and we're still below our signal line here. And if this was going to start to fail, this is the kind of signal we would look for. Now, one of the things we have here on this chart that we haven't seen on other charts is this is a flat PPO, relatively speaking, for the last 2 years, whereas over here it was quite an accelerated decline. So we aren't seeing the all-out sell of a dollar, we're just seeing the momentum waning that doesn't seem to have any upward bias left to it. I still think when these big trend changes happen, so here's 2000, and in 2000, this was a pretty important trend change. Obviously, that's when the technology stocks and I'll call it the internet stocks.com stocks started to break down. Now we have the service as a software or software as a service, kind of the same thing with high valuations that seem stretched. So we're looking at a couple of things and wondering, how long can this go on? And, as long as the music plays, it goes on for a while. But, the stock market bottomed around the 2008 lows, and we've been riding higher ever since. And so you get these big, meaningful trend changes that all of a sudden tell you, to start thinking differently about the dollar. And in this case, it was the explosion of the internet stocks, the 1985, I believe, was the oil embargoes and oil crisis. So we've got some big inflection points, and the question is, are we going to have one of those this year? So while the fear and greed index is extreme, the thing I'm starting to look for is what's not working or what's changing as we kind of reach this extreme. Is there anything showing me? And I think, the dollar's one of the extremes, the Fed adding so much liquidity when the market's still going up. Like, what's the problem? If everything's going to the moon and there's no problems in the economy, and so why is all of a sudden this taking off to the upside? Gold's starting to perform better. That usually indicates something going on. And on my bond charts, I don't have time to get into them today, but I've been trying to cover them off on some of my subscription stuff. And what you see there is they're set up. They haven't broken, but they're set up to give us some signals that we saw in 2000 and in 2007. And if they were to start doing that, then we'd want to be aware of that. So again, if you're interested in that, you can head over to the private investor tab at gregschnell.com and just check out what's available there. But the point I want to make is we're sitting here with an extreme fear and greed index at 97. And more importantly, I think what we want to make sure of is that we're, managing our expectations pretty well. So I kind of expect a flat year coming up. Thanks for taking the time to join me on Market Buzz. Market Buzz airs live on Wednesdays and Fridays at 10:30 a.m. Eastern Time, 7:30 a.m. Pacific Time on StockCharts TV. You can also catch replays on the StockCharts YouTube channel. Thank you. Happy New Year.